let's look at your portfolio and what's going on and how
right.
you're managing it.
Getting into the positions, huh?
Mm-hmm.
All right. Sharing my thing here. Bang. So AMD, we had earnings yesterday. We're up like, I don't know, was that like 8% roughly on the day? A little bit of a move to the upside. Kind of approaching the call break even, just about. Still like 7 points down or 10 points down from the call strike, right at the break even on the current. Yeah, pretty well within a standard deviation. A little bit tight on the call side. Maybe I'll be rolling the puts up a little bit here, adding some more buying power, rolling them from 85 to 90. We'll see. I'd like to sit on it right now. How many thetas I got on this? I got. It doesn't even say. I got to add thetas to my.
Well, man, how you not have your thetas, bro?
This is on a different account that I have. Yeah, net theta.
Yeah. So for anyone that doesn't know, thetas are options contracts have a date of expiration, which means as the option gets, as the option moves a long time towards its expiration, it starts losing value. That loss of value is called theta. So theoretically, if all else were the same, so if the underlying stock didn't move at all, volatility didn't change at all, James on this AMD position has
2.1 thetas.
2.1. Theoretically, he's making $2.1 a day from the decay of the contract because he's a seller. If he bought the options contract, then his theta would be negative
then also it's important to understand that that's for extrinsic value. For an example, like Paycom, which I'm going to get into, if you're selling options and your options are out of the money, you're positive theta. If your options are in the money, you might be slightly positive theta. If you're deep in the money, you're probably at flat or negative theta because now you're taking on intrinsic value, which is what's happening with Paycom here. So yeah, AMD up 8%.
Was it an earnings play?
Yeah, earnings play, volatility contracted. We could pull up the chart right here and see. I got
nice. So it's definitely probably it's up a little. What are your rate?
IVR right now? Yeah, as we can see,
IVR. Yeah, we love that IV.
Big smack to the downside, with a big bid up on the day. Look at that nice green candle. Not super huge, but we're gonna manage it. We're gonna see what we can do. We're gonna make it tasty. But Paycom is the butter for today. As you can see, we're well beyond where we should have been.
So your strikes are...
I had 280, 290, which in hindsight might have been a little bit too far up to the top side, and then 210, 200, which in the hindsight probably shouldn't have even put on this trade. But who could have thought? That's what the probabilities were.
Wow, so you're like well. So let's talk about managing the position here.
Yeah. So the traditional tasty trade methodology.
Maybe let's slow it down to show. Okay, so
we're down 40% or 35% on the day for Paycom.
Can we pull up on maybe TradingView like the strikes, the break evens?
You want me to pull up a chart of it,
or like TradingView? On TradingView, put the lines at your strikes.
All right, we can do that. There we are. TradingView down 36 and 3/4 on the day.
James put on a trade. Iron Condor, right?
Iron Condor. So defined risk. Probably should have gotten paid a little bit more for it, but was it 280? So that's just about 280. 290. That's about 290 right there. Could get a little bit more precise with it in a second here, but I just want to do this for education's sake. 210, and then it was 200. 210.
Do you want to just do the break evens just so it's two lines? Or that's fine. Okay.
Well, I mean, because I like putting the protection. I'm going to do the red lines as the one I'm selling, then the green lines is protection. All right, boom. I could get a little bit more precise with it, but, just 210, 200, 280, 290. So 10-point wide Iron Condor with $3.20 in premium. I could plot those as well. So $3.20. So my break even on that side, I'm going to put the break even as orange. Break even on that side, orange down here, -3, 20, boom. Wait, 3 and 20. Nope, it still doesn't make a line. All right, 320, right there. Boom. Okay.
All right. So the orange lines are if the stock stays between these two orange lines, James makes money. That's the simple of it. If
now
the
44 days left, I'm gonna put that down.
in the amount of time.
December 15th. Where's that? December 15th. Okay. All right. So as we can see here, I'm going to explain a little bit more in depth here. Red lines are the strikes I sold. The 280 call, the 210 put, 290 call I bought for protection, 200 put I bought for protection. I got paid $3.20 in net credit, putting up $680 worth of risk. My maximum loss is if I'll pull up a brush. Max loss is achieved if the stock goes above the green line, so anything over here, and anything under here, right? That's absolute max loss, but that's on this when we approach December 15th on this day. So if the stock moves outside of that range on December 15th, which is expiration.
However, even though this is the expiration date, we typically do not hold options through expiration. We actually want to, and we'll get into this in managing our positions. We typically
want to do 21 days.
Get out from around 21 days because after 21 days, the option itself.
The theta decay doesn't give you the most theta decay occurs within 45 to 21 or 60 to 21 days. That's the steepest part of the theta decay curve.
So you lose
21. There's still theta that you can make every day, but your gamma risk goes up.
Yeah. So essentially, the option within 21 days decays less. So as a seller, that's not beneficial, and the option itself is more volatile.
Yes.
So you're just more at risk and making less, pretty much.
More sensitive to large price swings in short periods of time, and it's not like a set in stone methodology of all right at 21 days you should absolutely 100% of the time take it off or put it or roll it out or manage it or whatever. It's just at 21 days, you might want to think about, you could do it at 23, you could do it at 17, but around 21, you want to consider doing something with your position because the other effects of the option pricing model will take effect and it will start to impede on your trading strategy. And as a bad trader, I don't have any strategy. But yeah, so, going back to what we were talking about, 21 days, you want to roll out to 45 days again. If you have your max credit, take it off at 42 days. Did that today. Yeah. That's the other thing. If you say get I remember Tom and was it Dylan Radigan on the Truth or Skepticism podcast were talking. If you make 25% or 35% or even 50% of the max credit that you're looking for, I'd say I think they were talking 25 or 35%. If you make that within the first couple days, it's probably in your best interest to take it off. Just because you got that move. I mean, it used to be. I remember old tasty methodology from 2018 when I was at Traders Expo. It was 25 to 35% of max credit. For iron condors. Now it's 50%, which is interesting. I don't know if they did more data, more research to suggest that the larger gain results in more money. I don't know what the math is behind it, but if it's 25 or 35% and within the first week, that's a no-brainer. You're getting half of what you looked for, and instead of you could get the half right up front within the first 3 days, and then you'd have to wait another 3 weeks for the other half. So it's a whole game of diminishing returns. What do you want?
So have you managed this position yet?
I have not, because I put it on yesterday. And so I said,
we can show,
we if we're within these lines, we're making money. If we're outside the green line, we're at max loss. And the price is all the way down. As we can see, we are well outside, so, I have to make a pretty significant leap in order to get back into money. If I wanted to break even, the stock would have to jump 32% within the next, until expiration. If I do hold this till expiration, if I wanted to break even on managed day, I need it to, rise $50 or 32% within the next, what is that? That's like 30 days, like 25 days. But yeah, no, the tasty methodology of how to manage a loser here is 2 rolls. And if you can't get back to break even or make profits, then you just close it.